Welcome. I'm Catherine Magana here with Rachel Ivanovich and Vince Stefano, where we're here to provide you insights on the markets, tax planning, and much more. Today is July 30th, 2026, and I can't believe we're already done with July. What happened? This month just flew by. But here we are. Stocks have rebounded a little bit from yesterday. There was a big sell-off yesterday. I think the stock market's really digesting the Fed Reserve meeting, and we still have the U.S. and Iran are back at it and fighting, and so a lot hasn't changed, but a lot has changed. We also saw the GDP numbers came out, and it came in at 1.5% during the quarter versus 2.1% was the estimate. So that came in a lot lower. Like I mentioned, the Fed came out and they did not change rates, which we kind of expected. So I was a little surprised the market moved as much as it did. But I do think with the voting and all that, I think there was some, I think the expectation is potentially there could be a rate change later this year. And then kind of looking, there's some earnings coming out. There's some positive, some negative, but that's obviously been affecting some of the markets as well. But looking at kind of the probability of a rate change, so the next meeting is going to be in September, on September 16th. And right now we're looking at about a 57.4% chance of a rate hike at the next meeting. The odds of a rate hike between now and the end of the year, the probability of that is about 77% that there's going to be a rate hike between now and the end of the year. And then looking at kind of where we're at with mortgage rates. So mortgage rates have come up slightly. Right now, the 30 years at 6.76% and the 15 years at 6.11%. And then looking at kind of where we're at for one-year CDs and treasuries, one-year CD is at 4.15 and one-year T-bill at 4.183. And then we're looking at the 10-year treasury now at 4.675. But if you actually look at some of the kind of 5 to 10-year corporate bonds, depending on the investment grade, those have actually come up over the last 30 days, some of those yields. So that's with some of the bond market that's out there. Let's see what else is going on. So we also have looking at the CPI, that hasn't changed. We reported last time it's at 3.5% is the inflation as of June. And so once again, we're still dealing with the war, the Fed, kind of some of the same things that are out there. But as I reflect back, I was looking at where we were at end of last week, Friday through as of yesterday's close. And yesterday the markets had pulled back, like I mentioned earlier. And so for the week, we were down in most of the indexes. But as of today, those indexes are all back up pretty much. So pretty much flat over the last week, even though it feels a lot worse. But the one that stands out the most is the NASDAQ. When you go back and look at the NASDAQ from a few weeks ago, that's the one that's down still the most kind of for this month. So we are seeing some of the tech and AI stocks pull back, and that's there's been a little more volatility in that sector. But all in all, we are still up year to date with our numbers. As of yesterday's close, which was July 30th, the Dow Jones was at about 7.35. The NASDAQ was at 5.17%. The S&P 500 at 6.88, and the Russell 2000 at 17.10. So once again, we're still up for the year. The biggest, I think, mover in the last 30 days has been the NASDAQ.
Which makes the most, obviously makes the most sense. Yeah. And, when I kind of was listening to what the Fed had to say yesterday, and it was very interesting. You had mentioned energy. Since the start of the Iran crisis, crude is up 30%. Well, that puts a lot of pressure on inflationary numbers, obviously. Mm-hmm. Last week, we mentioned productivity and how AI can really improve productivity. And the Fed actually came out yesterday and said that they saw productivity growth and capital investment in the United States being very robust. And so that's a good sign from an economic standpoint when you want some growth. They also talked about there is no soft inflation target. They want 2% inflation across the board, and that's what they're goal has been for the last few years. Also, you had mentioned interest rates, and over the last 42 days, Kevin Warsh, the chairman, mentioned that interest rates have been materially higher across the spectrum. And again, oftentimes that comes when you start seeing a stronger economy. And so maybe, the bond market is saying, hey, the economy is not as bad as some people think. Fed wants stable prices, full employment. That's great. You had mentioned the NASDAQ, and it was kind of interesting. The NASDAQ rallied significantly while the Fed was speaking, and they were doing their question and answer. Right after that, there was a news report that came out and said they were going to start, heavy bombing again in Iran, and the whole market all of a sudden, tanked. And when I look at, some of the factors, you still have higher oil prices. You've got the geopolitical uncertainty. You've got persistent weakness across the semi-cap sector. That was yesterday. Today is a completely different story because the semi-cap sector has got the NASDAQ really moving to the upside substantially.
I was looking, it's pretty much all the losses from yesterday are back today. The gains are back.
And what's kind of interesting is when you listen to the conference call, and again, you look at the earnings reports of all these companies that have come out and all of these companies talking about AI and talking about their investments in AI. One of the things that I'm seeing is that over the last couple of quarters, I think Wall Street analysts have set their consensus estimates so high that it's been very difficult for these companies to exceed what we're seeing is they're beating the current quarter, but they're guiding the future quarter in line. And I think that's because we've seen the lifting of the bar so high. And I also said last week on the conference, on our podcast, that when companies are, showing quarterly earnings and revenue of $100 billion plus, or in the tens of billions of dollars, and you annualize that, that's a huge number. So these companies are doing well. However, the street is still focused on the profitability of their AI investment. And what we're seeing is now that they're having to go to the bond market investors don't want to shovel a lot of cash into these companies. So we're seeing interest rates tick up higher because these companies that need money, they may have to pay a higher rate to get the money. One other thing that was kind of interesting, you mentioned the NASDAQ, and really this past month has been a very difficult time for technology stocks, especially AI-centric technology names. And as the names were selling off, I started nibbling here, nibbling there, nibbling here, and then they'd go down a little bit, and I'd nibble some more. And I felt like that Greek myth character Sisyphus who kept pushing a rock to the top of the hill, and then all of a sudden it would roll back down. I'd push it back up and roll back down. Anyway. What I found out today, and again, things happen in the market that you sometimes don't hear about until afterwards. A major hedge fund called Situational Awareness. It was a $20 billion hedge fund that was only AI-centric. They were the highest flying hedge fund the last 2 years. They have had to liquidate a huge portion of their $20 billion AI stock portfolio because of heavy losses this month. They've sold the remainder of their stock portfolio to Citadel. So that probably put a lot of pressure on the AI technology names that a lot of us like. Now, when that happens, you always see it in the rearview mirror, but oftentimes, you see these stocks go down dramatically. And again, the market, you don't know why. And now all of a sudden I see this and I say, hey, wait a minute, that's probably a good thing that we've had this liquidation because obviously there was probably a lot of heavy leverage here. And I'm going to say this again. I think that AI is going to significantly change everything in technology in the next 12 to 18 months. And these prices that we're seeing today are probably going to be some incredible buying opportunities. So, I look at it like, hey, AI is not going to put everything out of business. AI is going to enhance a lot of what's out there in the marketplace. But more importantly, I think that what you're going to see is AI start spreading out so dramatically through the entire market and the entire economy that it's only going to bolster, what's going to happen from an economic standpoint. So, I don't know. I feel like this month has been a terrible month, and I'll raise my hand and say, yeah, it's not going to look good when you get your monthly statement. But I can tell you this. The fat lady ain't sung yet. And by the end of the year, I still think that a lot of these stocks are going to be significantly higher.
So two things. One is I just wanted to kind of recap where we're at with the S&P 500 this year. So once again, that's more of a broader index that a lot of people follow. It doesn't mean you're necessarily in that, but just in general, that's one of the indexes we see. And so we've mentioned in the past, so as of the first quarter of the year through March of 2026, the S&P 500, we were down 9%. And so if you look at where we're at as of yesterday's close with the S&P 500, it was 6.88. And if you look at the 9% plus the 6.88 plus it's up today, there's a 16% move in, the first 6 months of the year. And so it's not uncommon for us to see big fluctuations in the markets move. And so we're not jumping in and out. It's once again, you are going to have diversified portfolio. Maybe the technology portion might be fluctuate a little more, but ideally, a lot of clients we work with, they have high quality dividend stocks, maybe some income investments. They have a diversified allocation. So while this sector might be fluctuating a little bit more, the idea is that you're participating, but you also have other investments along the way. So we're happy to revisit that with you on an individual basis, but I just kind of wanted to recap a little bit about where we're at with the S&P 500. And just to note, last year, which we've mentioned in the past, in 2025, the S&P 500 at one point was down 19%, and we ended up the year up almost 16%. So once again, the S&P 500 had a 35% move in 1 year. So you may not see that because we see it intraday or every year. But the reality is the markets, it's never going to just go straight up. It's going to fluctuate. Things are going to fall in and out of favor. And once again, to Vince's point, there's some solid investments out there. And don't be afraid if the markets move and fluctuate.
Yeah, and again, like I say, this whole hedge fund thing, I was like shocked when I saw it. But I wasn't shocked when I started thinking about why a lot of these stocks that are in the AI space have come down so much this month. And that's, $20 billion, and it was heavily leveraged. So, yeah, that was probably the other thing. So, the market has a way of letting you know what's happening.
Yes.
So I was going to talk about taxes. Surprise.
Yay. Our favorite.
But one of the things, we're almost in August, and that's the time of year where people should start thinking about tax planning. Hopefully you've thought about it a little bit so far this year. But oftentimes, the biggest mistakes that I see people making is not just one big tax decision, but it's a lot of little decisions along the way that they make year over year without questioning them. And so, for instance, and we've actually seen this with a couple of prospects who came in that we met with recently, is they automatically reinvest mutual fund distributions in their taxable investment accounts. And this can be a really great long-term investing strategy, but it also could not be, depending on your individual situation. You may decide to take that and invest it in something that won't be producing taxable income for you. So you definitely want to be looking at that because tax planning can be very complicated. One of the other examples that we actually see often is that a lot of times people will have multiple old bank accounts, brokerage accounts, retirement accounts from previous employers. And what this can mean for tax planning is oftentimes, and for your financial plan, is you could have duplicate investments that you don't even know about. And you may be over-concentrated. So you may be paying unnecessary fees because you have so many different accounts. And there might be a lot of missing opportunities for tax planning if you don't actually know. We often have had clients come in and then they're like, oh, I found this other account,
Yeah.
which I think is always hilarious, but it happens. And then another common one is waiting until tax season to think about taxes. And I know that, out of sight, out of mind, but it's always a good time to be, making those decisions for your taxes. Because by the time we're in tax season, we're acting like historians. We're just reporting what happened versus proactively making intentional decisions to reduce your tax bill. So usually the best tax savings come from decisions that are made before December 31st, and usually even during the summer or November, December. So a good question for you to ask yourself this month is there anything in my financial life that I'm doing simply because I've always done it this way? And sometimes you just make some small adjustments and it can save you thousands of dollars over the next decade. And really the best tax planning isn't about finding loopholes. It's about creating intentional habits that support your long-term financial goals. So.
Well, it's interesting. One of the things Rachel does with some of our clients and prospective clients is you take a look at the tax return, and you'll kind of interesting some of the things you find or point out. There was a prospective client that we're talking to, and one of the things Rachel pointed out was she has some interest that's tax exempt interest, but her income is pretty low, so we're kind of looking into.
Feels like a waste.
Yeah, it was like, why? So once again,
because the yields can be lower on that tax exempt interest, so it may make sense to go for something
a higher yield.
Mm-hmm.
Yeah.
Exactly.
So once again, those little nuances are definitely things that are out there, and you want to make sure you're aware of.
Because just because you hear something online doesn't mean it's right for your individual situation. It could make sense for somebody else, but not necessarily for you. So you always want to ask.
And then the other thing which we've talked about a lot is conversations about partial Roth conversions. Obviously, between now and the end of the year, and usually that fourth quarter is a good time to really look at, okay, what was my income, because things could change.
Well, and what you were mentioning this morning is right now it's a married couple, and they have the married filing a joint tax bracket, and so with their required minimum distributions later, it would be still in the 24% bracket. But if one of the spouses passes away, then all of a sudden you've only got the single bracket, and then they'll be in the 32 or the 35% bracket.
Yeah. So those are things that you have to think ahead and say, okay, is there any planning or things that we should be considering? And so once again, that's where the tax planning comes into play.
It's not just a tax you're paying this year,
Yeah.
but it's a tax you're paying across your lifetime.
And then recently, we have a client that has inherited some money, and we're revisiting kind of their overall plan and strategy of when they're going to retire and kind of how their investment allocation is invested. And so we are looking at adding some income investments to their strategy. And so once again, as things change in your life and there's inheritances or there's retirement, definitely bring us in that part of that conversation, because there's also at this point going to be some partial Roth conversions we're going to be discussing and looking at too. So once again, it's yes, the investing is important, and we want to make sure you're invested correctly, but we also want to make sure we're continuing those conversations with you about your lives and things that happen along the way.
Have to ask. Fear, greed.
Oh, yes. All right. So here we are. Okay. So it's July
Can't forget that.
30th. And right now we are 34, which is fear. And so just to recap.
Is there an extreme fear, or is
There
it just
is.
fear?
So 0 to 24 is extreme fear, although we're probably for some reason we feel like we're extreme fear, but we're not. We're in fear right now. Fear is between 25 and 44. And then 45 to 55 is neutral. 56 to 75 is greed. And 76 to 100 is extreme greed. So we're in the 34, which is fear, and that basically says investors are nervous and careful with their money. So, which I can kind of sense the sentiment with the markets of where they're at.
Yeah. And a lot of it is what they hear about, what's going on in the AI space.
Yeah.
And, I'm going to leave with this last little tidbit. We keep hearing about monetization and when these companies are going to monetize their AI investments. But right now, hundreds and hundreds of billions of dollars are spent on the build out of these databases. Mm-hmm. And the problem is they're still in construction phase. So they haven't really moved into the real AI space yet. So, I mean, they're still building these data centers out. They're putting in all the stuff, the, air conditioning, the heating. So I think it's going to be another, I don't know, 9 months, 12 months before a lot of these databases are completely finished so that these companies can then stop spending on the build and then look to the monetization. But again, the street will start looking, 6 months prior to that, and so these companies may start moving well before that. So keep an eye on the database construction, because once you start seeing that kind of come to an end, you may start hearing that the CapEx spend is going to be reduced substantially.
All right, I think that concludes for today. So thank you for joining us, and we'll see you next week.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.